High returns is equals to high risk. Listen to me carefully. I'll repeat it again. High returns is equals to high risk. Nothing in this world is free, and I can guarantee you that. Sorry, that was intense. Hello, I am Yash Roongta, the founder of AltXtra, India's first and largest community on alternative investments. And I welcome you to
AltXtra series
powered by Grip Invest.
with AltXtra.
We are decoding the complexities of high yield investments to help you make smarter investment choices. Today, I would like to discuss a very important relationship, an unbreakable bond between risk and return, and how understanding this perfect couple can make your marriage with investments a two-sided love story.
अरे कॉल आ रहा है, राहुल का फोन आ रहा है, इसको मैं अभी फंसाता हूं. अरे राहुल, बड़े दिनों बाद कॉल किया. अच्छा, I'll tell you, बहुत सही टाइम पे कॉल किया है. I have a very good investment opportunity for you.
Really? What is it?
I will offer you 18% IRR in an agri investment which will be guaranteed, and you know what's even more amazing is that it is tax free and there is almost zero risk in that investment.
Oh, really? That sounds amazing. Is the return really guaranteed and tax free?
Of course यार, मैं क्यों झूठ बोलूंगा तुमसे.
Amazing, boss. ले लो मेरा पैसा. Take all my money, make me rich.
Amazing. I'll be in touch, Rahul. Thank you so much.
Well, this was an easy fish to catch. This conversation is a classic example of how high returns and guaranteed returns are often used to attract investors. When you add tax-free returns on top of it, investors just lose it. Rahul, he never questioned me how the return is guaranteed. How am I able to generate so much returns? And that, according to me, is a big problem. Some of you might already know how such cases have turned out in the industry. If not, just Google it. So, understanding the balance between risk and return is really important and can make you an informed investor. So, how do we measure risk? Well, if we have to talk about equities, investors analyze company fundamentals, cash flows, and metrics like beta or standard deviation. They also review management discussions and future plans. It is too much analysis, but at the end of the day, it's worth it. When it comes to fixed income products, the focus shifts to whether the issuer can service the debt until maturity. The primary risk is the solvency of the issuer. Arey, what do all these terms even mean? Chalo, no problem. Let's understand this with a very simple example. Suppose you like a pizza brand called The Thin Crust, and they have come out with a bond issuance at 11% IRR for 2 years, and they plan to use that money for daily cash flow needs. The Thin Crust is also listed on the stock exchange. Now you can either choose to buy the equity of the company or buy the bond. When you buy the equity, you are betting that the company will grow and so will your money. But when you buy the bond, you are just betting that the company will be able to survive for the next 2 years and will be able to make interest plus principal repayments. You don't care about its growth that much in this scenario because you won't get a piece of that. Instead, you chose to get steady, stable returns over the next 2 years. So the risk of a company going bankrupt is a major risk which needs to be evaluated in fixed income products. Let's break it down a little further on how higher returns usually mean higher risk. For example, a big brother bank FD offers 7% return, while a small brother bank FD offers 8.15% return. What's the difference? Well, Big Brother is more established and experienced. So chances of them doing wrong things or going bankrupt in this case is lesser than the smaller brother. I'll in fact give you a golden rule to always think about when you invest in fixed income products. Indian government bonds offer around 7% interest and are considered absolutely risk-free. It's called sovereign guarantee. If anyone pays you any return above 7%, there is always some risk associated with that deal. It is best to clarify with the platform or issuer of the security on what these risks are. To give you an example, this can be credit risk, which is risk of going bankrupt, liquidity risk, that is how easily can I exit from this deal, fraud risk, somebody did accounting ghotala or something else, operational risk, and many more. In India, fortunately, we have a robust credit ratings framework that can help measure overall risk. It starts from AAA rating and goes all the way down to D rating. The rating agencies have been fairly accurate in determining the ratings as well, especially after the ILFS defaults that happened a couple of years back. But you should not just rely on ratings because occasionally they have been wrong as well. Here's a quick checklist on what else can be evaluated. First, check the platform's credibility that is selling you the security. Second, check the profile of the company raising debt. Check how credible their management is. Third, check existing debt on their balance sheet, cash in hand, and the history of debt repayments. Fourth, check the health of cash flows if that is available to you. Fifth, check the security structure of the debt raised. This can be in the form of post-dated checks, personal guarantees, and other things. Sixth, check if there are any large co-investors investing alongside you in the deal. Always ask yourself, how am I protected if the issuing company defaults? I want you to repeat this with me. How am I protected if the issuing company defaults? And only invest if you are comfortable with the risks. In conclusion, I'll repeat my favorite line again. High returns mean high risk. Credit rating agencies provide a good starting point to measure risk, but don't rely on them blindly. Use our checklist to guide your investment decisions. If you do this basic homework, I can guarantee you will not lose money in any obvious scams. Thanks for watching. If you would like to add something to our checklist for evaluating these opportunities, do let us know in the comments below. We are looking forward to it. Stay tuned for more insight in our AltXtra series powered by AltInvestor and Grip Investor. In the next video, we'll talk about the concept of fractionalization and why SEBI is so bullish about it. Hope you like this video. Don't forget to like, share and subscribe, and watch out for AltXtra series for more such content. Thank you.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.